Good evening, friends. Hope you are well and doing fine. I am Ashok Kanawala on behalf of HDFC Mutual Fund. Extend a warm welcome to all of you to this webinar to discuss economic and market outlook. Last 3 months, I think since beginning of October, the markets have seen heightened volatility. And that volatility is continuing even in the current new year that has started. Now, the best part is that this volatility is not only extended to equities, but to all asset classes. So be it debt market or bond market, gold, or for that matter, even currency market. So you would have seen our currency almost depreciating from 84 to nearly now 86.5 and above. And the best part is that this volatility is not only restricted to India, but it's outside India to the external world also. So you would have seen even on the currency front, almost all currencies other than US have depreciated. The reasons for Indian volatility started with a kind of a slowdown that we saw in Indian economy and some kind of earning downgrades. And of course, thereafter, FI outflows in India and globally more to do with the outcome of the US election. Now, that has been the past. Now, what do we hold for future? Now, the same thing, because a lot of optimism is coming out of the authorities within India that there will be a recovery. There was a one kind of a blip in our economic growth and it should rebound. So we have to watch that. How earnings seasons pan out, that also will be there. And of course, the swearing in ceremony, which will happen for the US elections around January 2022. So that will be a key event from a global perspective. But we have budget coming up and thereafter the credit policy and how the RBI takes a view at the inflation and interest rate. So there are a couple of events around the corner, which is going to influence the market. Now, as we know that short-term volatility may continue, and it's always hard to sort of predict the market in short term, but it's a medium-term prospects that drives the direction of the market. And as we always say that in the short-term markets are voting machine and in the long run, it's a weighing machine. So that's what we are here today because recently we have released our annual publication, the Yearbook, which articulates our thoughts on the economy, market outlook, and where are the opportunities. And to discuss all about that, we have Chirag Setalvad, our head of equities. Chirag needs no introduction to people who have been associated with us for a longer period of time. He's been with us for more than 2 decades. And today, with his team, he manages more than over 5 lakh crores of equity. Personally, in the small and mid-cap space is a name to reckon with, where he manages more than 1 lakh crore of aggregate AUM in small and mid-cap space. So he will be sharing his thoughts, how he sees the current market, current economic scenario, locally, globally, what are his thoughts, which have been well articulated in our yearbook. So whenever you get an opportunity time, please go through that, please peruse that. So with this, now I invite Chirag to begin his opening remark. Over to you, Chirag. Our investors and partners are on this call.
Yeah. Great. Thank you, Ashok. Thank you for hosting the call and thank you for all participants for joining this afternoon. As Ashok highlighted, we've come out with our annual yearbook and my intention is to go through. So let me start with the presentation. It really has a couple of components. It covers the year gone by, India's macroeconomic outlook. Of course, the most interesting part will be Indian equities valuation and the outlook going forward. We won't cover the fixed income bit. We'll have a separate call with Shobhit Mehrotra, head of fixed income, on that part. We'll touch upon global perspectives a little bit. And I think importantly, we will also discuss what we think are the key factors and the key tenets of equity investing. So let me start with the year gone by. It's been broadly a strong year for equities across various geographies. We've seen fairly strong performance, certainly in some of the riskier asset classes. Bitcoin has done fantastically after having a very strong last year. Bitcoin gave another strong year this year with a 120% return. The Mag 7, needless to say, have done extremely well, have given 70% return. Gold, surprisingly, has also done well in a risk-on environment. Gold has given a return of close to 30%. And US markets, as you can see, have done extremely well. US economy has surprised positively, and S&P 500 has given a return of more than 25%. And in fact, a lot of this has come from the contribution of the Mag 7 itself. In fact, 65% of the S&P returns in the last 2 years comes just from Mag 7. The MSCI World Global Index is up 20%. So in that sense, equities as an asset class has done quite well. Nifty has been somewhere in the middle with a return of about 10%. So Nifty itself has not done exceptionally well. It's really mid cap and small cap in India which have done very well. And we will cover the mid cap, small cap bit in the valuation segment. When you go to just equities themselves, NASDAQ and S&P 500 lead the charge with a 25-30% return. Hang Seng has bounced back and given a 23% return. Nikkei has done well. You see FTSE somewhere in the middle over there. And in general, developed markets have done better than emerging markets. Developed markets have given 4-5% higher returns than emerging markets. Europe, despite being in the doldrums, their equity markets actually have done reasonably well. So America did well. Europe did reasonably well despite a struggling economy. Japan also did quite well. So emerging markets as a whole developed markets as a whole did quite well, and emerging markets were laggards, though they give a strong return themselves. Moving to India specifically, you can see in this chart that India has had a fantastic run. We have given 9 positive years of returns for the Nifty, which is really a spectacular achievement. And we'll get into this on the valuation piece, but clearly after having 9 such fantastic years, there is some merit for caution, and we will dwell upon whether that's more in mid cap, small cap, large cap in the valuation segment. But mid caps and small caps have clearly done a lot better, while the Nifty 100 has given a return of 13%. Mid caps have given 24%, and small caps have given 27%. Now, one of the reasons behind this, of course, is that the growth in earnings for mid cap and small cap has been far better than that in large cap. So large caps have given a 9-10% earnings growth in the last 10 years, and mid caps has given 15-16%, and small caps have given 12%. So really, mid caps, small caps growing 4-5% ahead of Nifty or large caps, and hence that has driven the returns in the mid cap and in the small cap segment. The question though now is, are valuations overstretched? We've seen some correction from the top, and we'll touch upon that on the valuation part of the presentation. This is a little bit of a snapshot in terms of how sectors have done well. So pharma and IT were the leading sectors of last year, giving returns of 40 and 20% respectively. Banks and commodities were relative laggards, giving out 5-6% type returns. And as a result of this, what we are seeing is that pharma and IT now trade at a premium to their historical averages, 25-30% premiums in both pharma and IT. And not surprisingly, that banks and commodities having lagged, they are now trading at a discount to their long-term averages. And I think it's important to keep in mind that the market rotates. And what does that mean? The market rotates from sector to sector. There are years in which pharma, IT, auto will do well. There are other periods of time when different sectors will do well. So the market does rotate from sector to sector. So it's important not only to focus on the sectors which have done very well, but also to look at sectors which are laggards and see if there is reason to be optimistic on those. The market also obviously rotates between large cap, mid cap, small cap. Last few years has been dominated by small and mid cap, but that doesn't mean that we ignore large caps. In fact, we feel today there is relatively more safety in large cap compared to mid and small. And the market, again, that mid cap, large cap flavor tends to rotate over a period of time. The market also tends to rotate, interestingly, between style. And there are periods of time when growth does well, and other points when value does well. So again, the market tends to shift from one to the other. And I think that's important to keep in mind, because we need to have a diversified portfolio as an investor. You don't want a portfolio which is entirely skewed to a particular style, entirely skewed to a particular market cap, or for that matter, entirely skewed to a few sectors. So let us talk a little bit in terms of the macro outlook. We'll spend a little bit of time just analyzing how India stacks up compared to other global economies. I think this bit is well known that India is growing far ahead of its peers. We are also slowing down. This year, growth is expected to be roughly 6.5%. And I suspect next year will be similar, if not a little bit lower. So India's growth is still far ahead of its peers, whether it is China, whether it is other emerging markets, and of course, the overall global economy. But our growth is also slowing down by 0.5%, thereabouts. But I think the outlook from a longer term perspective continues to be extremely strong. India's debt to GDP is amongst the lowest when you compare to other economies. India is the black line in the chart over there. So I think in that sense, we don't face the risk of over leverage from an India standpoint. And I think India has done a good job from an inflation perspective as well. And what we've shown in the chart here is how inflation has trended over the last 10, 15 years. And India, which used to have an inflation profile of 8-10%, and that was the norm, and we had been used to that, that has actually come down quite sharply in the last decade or so. And we are now down to this 4-5% handle. Interestingly, in that same period of time, the rest of the world, particularly the developed market, where inflation used to hover around 2 to 3 to 4%, that has actually inched up and has come to 5-6%. So today, the inflation profile of India is quite similar to the rest of the world. So in that sense, India is on a far better footing. When you look at it from a debt standpoint, actually global economies have a higher debt to GDP ratio compared to India. And of course, their growth is lower. So when you look at this mix of growth, leverage, and inflation, India really stands out. On top of that, if you add the layer of politics, where India has had a sort of stability from a political standpoint, unlike the US, unlike the UK and other geographies, it really provides a very strong picture to have a strong political backdrop, strong growth, low leverage, and at the same time, inflation, which is quite benign. And I think this is the reason why India's valuations have moved up. So we do believe that the premium in valuations to some extent is justified because India's profile has improved significantly in the last decade or so. And this will translate into India becoming a far larger economy. We are moving from being the fourth or fifth largest economy in 2029. And I think most people are aware of this, that we will be most likely the third largest economy. We will be the fifth largest stock market. So I think gone are the days where India is a fringe market or a fringe economy. You cannot ignore a number 3 economy, nor can you ignore a number 5 market. Interestingly, though, even though we get to a number 3 position, we still have a long way to go because our GDP per capita is still far lower than what you see outside. And at $4,000 odd, which is what it is expected to get to in 2029, we still have a long way to go from a growth standpoint. And growth will be driven by a variety of factors. We have a very strong demographic dividend, which means a very strong demographic profile, and we'll touch upon that later on. There is significant manufacturing potential, which is still relatively untapped. Services has kicked off actually very well. India's services have done particularly well in the last 4 or 5 years, and we think that engine will continue to grow. And because of our demographics, consumption is a big source of growth in the future as well. And lastly, from an investment standpoint, the government has spent a lot already in terms of infrastructure, and that will continue. Over and above that, we see private investment coming back, and that will give a further thrust to the investment part of the economy. So when you put all of this together, really, you recognize, or we recognize, that there is a lot of potential for India from a medium to long-term growth standpoint. And I think this is really important. When we look at the stock market very often, we try and figure out, or we try to ascertain what is happening in the near term or the medium term. But if you look at the long term and you recognize that India is a 6-7% growth economy, you add another 5-6% in terms of inflation, and we are a 13% nominal growth country. At 13% nominal growth over a period of time, corporate growth should also reflect that. In fact, corporate growth should be actually higher than that, because agri, which is about 15-20% of GDP, is not represented in the stock market. So if the economy grows at 12-13%, actually corporate growth should be a little bit higher than that. And over a longer period of time, stock market should also give a return in line with that kind of performance. Now, the near term can always be very different depending on how valuations move up or valuations move down. But for those investors who put in money for an extended period of time, the stock market will reflect the economy, and the economy is growing at 13 odd percent. And hence, I think the outlook from a long-term standpoint continues to be extremely positive. Let us just spend a little bit of time on each of the factors driving growth. I won't spend too much time, but just to highlight, I think, some of the interesting data points. And here we have the advantage of demographics in India. And in fact, the rest of the world is struggling with an aging economy. In the next 25 years, India will see 179 million people getting added to the age group of 25 to 60, and where actually it is falling by 103 odd million. In European Union, it's falling by 50 million, and Japan, it is also falling. So in that sense, India really stands out quite well. Of course, you have to provide adequate employment to the people entering the workforce. And I think that is one of the key challenges that is facing the current government and the next government as well. And if that doesn't take place adequately, then that is a concern. So the idea here is not only we don't want to present an overly rosy scenario. We want to give you a balanced perspective. There is a lot of opportunity from a demographic standpoint, but if we don't harness it adequately, what is a demographic dividend will turn into something negative. Right now, India's dependence on agri continues to be very significant. 49% of people are employed in the agri sector compared to 12% in manufacturing and 39% in services. So a huge dependence still in agri. And as we become a more developed economy, people will shift from agri to manufacturing to services. And manufacturing is 3.5 times, and services is close to 4 times the productivity of agriculture. So this really drives GDP growth. As you can see on the right-hand chart, countries with low agri contribution have high incomes and high per capita incomes. And India, as it evolves and becomes more urban, less rural, and less agri-dependent, will move along that path as well. Manufacturing still has a long way to go. I think this has been an area of disappointment, if you are to be honest, and is an area of focus for this government, and I suspect for subsequent governments as well. When you look at how manufacturing as a percentage of GDP has behaved in other countries, it peaked at 25, 28% in most countries: UK, Korea, Indonesia, China, Vietnam, etc. In India, it actually peaked at 17% and has come down to 13%. So manufacturing is an area which has a lot of advantages. And today you have the advent of China plus one because of geopolitical issues, Europe plus one because of cost issues. And of course, India is incredibly competitive and a large market onto itself. And that itself gives a lot of impetus for companies outside of India and within India to invest in manufacturing. So I think this number of 13% will certainly move up over a period of time. India's labor costs really stand out. Productivity is lower, but we are almost half the cost of countries like Thailand and Vietnam, and a fifth of the cost of labor in China. So in that sense, the advantages of manufacturing in India from a cost standpoint, from a labor standpoint, are quite significant. And India's share of exports continues to be on the lower side. We've barely reached 2%. And you look at how China has behaved. China has gone from 4% to 14%. So a 10% increase over a 25-year period. And in that period of time, pretty much everybody else has lost out. Germany, US, Japan, everybody else has lost out. And that share has pretty much been taken up by China. And I think it's a fair guesstimate that over the next sort of 15, 20, 25 years, the share of China will come down. It's unlikely that that share will be taken up by high-cost economies like Germany or Japan, or for that matter, the US. So that share will come to cheaper economies, cheaper manufacturing centers. And that, of course, will include not only India, but it will include Vietnam, it will include Indonesia and Thailand to some extent. But I think we are well poised to see this number of 1.8% shift and go up. And we've already seen reasonable progress. If you exclude China, India is now the largest manufacturer of smartphones, the second largest manufacturer of ACs, and fourth in refrigerators and so on. So we do have the engineering capabilities, we do have the costs, we do certainly have the management talent as well. So I think what is lacking has been a government focus, which is now coming in. I think what is lacking is infrastructure, which is also now beginning to improve. And all these will set a foundation for India's manufacturing to pick up quite significantly. And this is why we at HDFC launched our manufacturing fund this year, because we do feel that there is a lot of potential in manufacturing over a period of time. Services, actually, the story has been a very positive one, and it's not just IT, but just look at India's share in global exports of services. It's moved up quite nicely in the last 4 or 5 years. And it has grown at almost 19-20%. 2/3 of GCCs are now based in India. And we have an incredible talent pool. The number of STEM graduates in India is 2x what you find, or 3x what you find in the US, and 4, 5x what you find in other countries. So you don't get this kind of talent pool anywhere else. So GCCs having a strong performance in India has led to the current account in India also improving significantly. And I think this will continue. We don't see any slowdown on this. And so the services engine is kicking off quite nicely. We think the manufacturing engine will also pick up over a period of time. And then you come to consumption. I think there is a long way to go in consumption. Over the next decade or so, we expect that the contribution of the upper middle class and will rise significantly. And that will lead to significant consumption as the pyramid becomes more evenly balanced. Of course, urbanization is a big driver. More and more people are moving into urban areas from rural localities, and that drives consumption as well. So consumption too has a long way to go. Capital formation, infra investments, we see it all around us in every city that you go to. But India is still highly underinvested, whether it is containers per capita or roads per capita, passengers per capita. I guess the denominator is so large that the number comes down. We have a long way to go. I have done a remarkable job in increasing investments, and GFCF has increased from 27% to 30%. But it can go higher. It used to be 35% if you go back to 2007, 2008. So a lot of focus in every budget on CapEx by the government, and you can see that visibly on the ground. And I think this is something which has now become apolitical. I think this is a commitment and a requirement for the next several decades, and this will continue as well. Private CapEx has been the part which has been a laggard. Private CapEx is the CapEx by corporates. And what you can see here is on the left-hand chart is that government has taken up a lot of the spending. So the share of government as a multiple has increased significantly compared to private CapEx. And but over a period of time, because of the manufacturing opportunity, because of higher consumption, we do see greater CapEx as well. And companies are in a good position to do that because the debt equity ratio of listed companies has fallen quite sharply from what used to be 1 times or 1.2 times. It's fallen to sort of 0.5, 0.6 times. So in that sense, there is a lot of opportunity for companies to lever up and to invest in CapEx. So government CapEx likely to continue, and private CapEx should hopefully pick up. So when you put all of this together, the services element looks strong. The manufacturing segment has a lot of opportunity. And government CapEx likely to continue. And then, of course, private CapEx, which so far has been subdued, could also pick up. This, along with the digital economy, I'm not spending time on this, but the slide, but has put, I think, together a framework which sets a foundation for very strong growth for the next several years. Now, that brings us to the Indian equity valuation piece. We know the markets have done extremely well for the last 7, 8 years. In fact, 9 years, we've had positive returns, as we highlighted earlier. So the key question is, how are valuations today? Mid caps, small caps have done extremely well. We've seen a little bit of correction of late. We've seen the market, mid caps correct by about 10, 11%. And small caps as well. In fact, large caps have corrected 10, mid caps 12, small caps 12. What is interesting is in this correction of 10, 12%, individual stocks have actually corrected a lot more. So 30 to 40% of the mid cap and small cap index have corrected by more than 30%. So the overall index is just down 10, 12%, but within that, almost 30 to 40% of the index is corrected by 30%, by more than 30%. So we'll get to that in the next few slides. But before we talk about the current scenario, let us just take a step back and see how India is positioned. When you look at our profile, India is a very diversified stock market. So when you look at the weightage of the top 5 sectors, in India, it just accumulates to 68%. And when you go to other countries like Taiwan, Indonesia, Brazil, etc., they tend to be dominated by 1 or 2 sectors. That could be technology, that could be electronic manufacturing, that could be commodities, and so on. So, when you have a more diversified profile to the equity markets, it tends to bring in more interest and capital over a period of time. India is also a very large market, not only from an overall market cap standpoint, but you look at the number of individual opportunities. The number of companies with a $1 billion market cap has increased from 260 companies in 2019 to more than 560 companies today. And that means it is a lot more investable. We are the 5th largest market. And if you combine China and Hong Kong as one market, then we'll probably be the 4th largest market. So we're a large market. We have a lot of liquidity. We have a lot of companies. We have a lot of diversity from a sector standpoint. And I think that will garner a lot of interest, not only from domestic investors, but from foreign investors over a period of time. We've already seen India's weight in global markets rising quite sharply. India used to be 8-9% 5 years ago of the MSCI index, and we are now almost 20%. So that's almost a doubling of weightage. And India, again, is interesting because we have a strong return on equity. So you look at return on equity in India, it's 15-odd%. That number is itself a fairly impressive number and stacks up quite well with the 15-16% that you see at the higher end. And in fact, when you adjust for the fact that India's representation of financials is quite high. So financials are almost 35% of the index. And if you were to take that out, then actually this return on equity goes up because return on equity tends to be lower for financials than for non-financials. So barring financials, we would be closer to that 15-16% that you see in top tier ROE economies. So India's return profile is also very, very strong. And fortunately, the dependence on local investors has gone up. And I say fortunately because domestic investors tend to be more steady, that inflow tends to be more regular. DII's ownership of the stock market has gone up by 3-4% from what used to be 8-odd% to 12-odd%. So domestic institutions are playing a more important role. And the penetration of mutual funds is still low. The penetration of insurance is still low. SIP programs are very strong, and hence we think that DIIs will continue to play an increasingly more important role in the markets. FI dominance has come down to some extent. So FIs, which used to own 24% market, that has come down to roughly about 20-odd%. So domestic institutions, I'm quite confident over a period of time, their ownership will cross that of FIs. And that's, I think, it's great from a stability standpoint. While markets have done well, that encourages a lot of activity in the primary markets, in IPOs and so on. This year, we've seen $38 billion of money getting raised through IPOs, FPOs, QIPs, and so on. So liquidity getting sucked out through the primary market. And this is a concern. If this were to continue and inflows for some reason were to slow down, then this can pose a risk to equity markets. Promoters have sold $13 billion in this market, and that sometimes raises a concern for us. Promoters obviously have great understanding of their own businesses. And if they are selling, then we need to be a little bit careful. But some of that is for fundraising. This is not only selling stake to put money into your pocket, but selling stake to raise finances in a particular company. But this is an area which should be keenly looked at and watched. Retail participation has risen sharply. We've seen a 30-time increase in F&O activity And this is, for me, an area of concern. Retail tends to be nimble-footed and not always long-term in their orientation. And certainly F&O is not a long-term investment vehicle. So there is a little bit of, I think, overexcitement in the retail part of the market. That has tempered quite a bit in the last month or so. And we've seen actually the retail mix dipping down a little bit. But whenever retail excitement peaks, markets tend to peak along with it, and that gives us a little bit of a reason to be cautious on equity markets. So that brings us to where we stack up from a valuation standpoint. So let me first get into large cap valuations, and then we'll get to, I think, what is probably more important, which is mid cap and small cap valuations. So large cap, this is MSCI India. You could look at it for Nifty for that matter. You can see that India trades at a PE of about 22 odd times compared to an average of 20, roughly 20. So we're at about a 10 odd % premium. Nifty is in fact at exactly a 7% premium. So large caps are not expensive. 7 to 10% premium, considering India's growth profile, considering the outlook, considering the uncertainty in other global economies. I think that kind of premium is justifiable. So large cap valuations we remain comfortable with, and large caps represent roughly 60% of the total market. Within that, if you look at it from a sector standpoint, and we touched upon this earlier, that service, IT, pharma, industrials have done very well, and as a result, their valuations now trade at 20-30% premiums. So we are relatively a little bit cautious, but again, individual companies continue to look interesting. Banks, auto, metals, staples, and for that matter, even oil and gas are relatively better priced, trading at close to average valuations, and we're finding increasingly more opportunities there. But I think it's important to point out, even in sectors which are expensive, we do find interesting individual ideas. So it's not that we are bereft of ideas in industrials and services and pharma and so on. So this is for the overall market. What you can see here is Nifty, as I said, is about a 10% premium. With the recent correction, that's come down to about 7. Mid caps trade at about a 40% premium. Small caps trade at a 40% premium. I think it is this mid cap valuation premium which is of concern. But if you are a long-term investor, if you are investing, so let us take the 3-time horizons. Let's take somebody who's investing from a 1-year standpoint, a medium-term investor who's investing from a 5-7-year standpoint, and a long-term investor who's looking at it from a 10-15-year standpoint. So 42% premium, you assume that some premium is justified because of India's growth profile. Some premium is justified for mid-cap, small cap, because they themselves, as you can tell, are growing faster. So maybe 20-30% is the excess. I think 20-30% excess for a 1-year investor is a big risk. But if you're investing from a 5-7-year standpoint, that means you have to adjust your return expectations by 3-4%. That's 20-30% divided by that 5 years, it's roughly 4-5%. So I think that's still a reasonable return profile if large caps can give 12-13% returns, and if mid caps can give sort of 15-16% returns. On a normalized basis, valuations come down over a period of time in mid caps and small caps. I think we can still have a good return profile. And the same applies to small caps as well. So if I were to summarize this, I think large cap valuations are sensible. That's 60% of the market. 40% of the market, which is mid cap and small cap, continue to be expensive. These premiums have already come down. This used to be a premium of 60 odd percent, with the market correcting 10-15%, and with the passage of sort of a couple of quarters, that premium has shrunk to 40 odd percent. So markets are not, certainly when you look at mid caps and small caps, if you were to put the market into 3 buckets, markets are cheap, markets are reasonable, markets are expensive. When markets are reasonable, you have fantastic returns. When markets are cheap, you have fantastic returns. When markets are reasonable, you have sensible returns. And when markets are expensive, you obviously have suboptimal returns. We're certainly not in an environment. In large caps, I think markets are reasonable. So your return profile will be reasonable. In mid caps and small caps, valuations are on the higher side. So we need to temper down our return expectations. But again, I want to point out that tempering is really from a short and medium term standpoint. If you're a 15-year investor and the market is 30% expensive, you really take away 1.5%, 2% of returns. It doesn't change your return profile. So I think mid cap, small cap, I continue to be extremely positive from a long-term standpoint. I continue to be quite concerned from a short-term standpoint. And I remain reasonably balanced from a medium-term standpoint. And I think that's an okay mix, considering that in any case, considering the volatility in small caps and mid caps, we shouldn't be investing with a short-term horizon. We should certainly at least have a mid-term horizon, if not a long-term horizon. I think the area that we have to be careful of is growth in earnings. Overall economy is slowing down, and as a result, corporate earnings are also expected to slow down. So post-COVID earnings grow at sort of in the mid-20s. That's expected to come down to the teens. So that will certainly have an impact on returns over a period of time. This slide just highlights that this is not only about picking the right segment of the market, but also picking the right stocks. There's a lot of debate about whether one should do active or passive investing. I think it's good to do both, a little bit of active, a little bit of passive. But I certainly believe there is a lot of opportunity still in active. What are we highlighting here is if you break up a sector or Nifty in this case into the best performing quartile and into 4 quartiles, the best to the worst. There's a stark difference in performance naturally between the best performers and the worst performers. And it's a fairly big difference with the best performers giving a 24% return and the worst performing companies giving a 2% return, negative 2% return. So if as fund managers, we can add value to portfolios by picking and choosing better performing companies, then we can add that incremental alpha to our portfolios. Risks are I'm highlighting them here, but risks are always part of any market. The interesting part is these risks. If you look at our presentation every 5 years, this slide changes the most. The risks of today are not going to be the risks of tomorrow and vice versa. But there is certainly a risk that the US economy continues to remain strong, and that brings down the possibility of rate cuts. Geopolitical situation can always be volatile. In fact, today there's an opportunity for risk to come down, and we've seen what got announced yesterday from the Israel-Palestine conflict standpoint. Uncertainty on tariffs. This is a big risk. Mr. Trump will certainly impose tariffs. We're not sure how much, but that can shave off 1 to 2% of growth. We have a slide on that, I think, later on. And it can add to about 1% to inflation in the US. So there will certainly be uncertainty as the new regime in the US comes in. Weakness in global growth. Global growth is slowing down. So that is an area of concern, but India's growth within that remains strong. Earnings, we pointed out how earnings is slowing down from early 20s to mid-teens. And we need to watch that to see for any further downgrade in earnings. And the last is, of course, there is valuation risk. And we spoke about large caps not having much, but mid caps and small caps where we need to be careful if you're a short-term investor. And that's a risk that is posed to the markets as well. We are not going to cover the fixed income outlook. I'll leave that for Shobhit to cover at the next time. So let me quickly have about 5 minutes to wrap this up. In terms of global perspective, and then we move to Q&A. So we spoke about global growth slowing down. So what you see here is most countries are slowing down. Actually, interestingly, the Euro area and United Kingdom, after having very mediocre growth for a couple of years, is expected to actually improve a little bit. But the overall global economy will slow down from what used to be 3.6% to what is expected to be 3.2%. So there is certainly a slowdown which is visible and across most geographies, barring a couple. US growth has so far been very, very strong. You can see out here it's been above average. I think the US has now surprised us for 3 years in a row in terms of growth. And because of that, and because of AI and so on, performance of Mag 7, US market cap is now really dominant. US market cap of total global market cap has crossed 50%. So this is, I think, in itself a risk. We speak about India valuation risk, but possibly the valuation risk is more outside of India. And if the US market or the US economy gets a cold, we'll all struggle. It's not that India is completely insulated. We're relatively insulated, but it'll certainly impact us as well. And the fact that US market cap is at more than 50% and P multiples are elevated is the source of concern for me. This covers the tariff bit because this is a very sort of hotly debated subject and discussed and so on. But if you assume what we've spoken to economists and understood is that if the US were to impose a 60% tariff on China, which is what Mr. Trump has suggested a few times, and a 10% tariff on the rest of the world, then it impacts inflation by about 1%, which is that PCE price that you see in the first column, and impacts GDP adversely by about 1.5%, which is what you see in the last column. So we need to see how this happens. I think there's, my perspective on this is that there is a lot of conversation and banter in the run-up to elections, but post-elections, everything tends to temper down a little bit. So I wouldn't be surprised if tariffs actually, they will come in certainly, but may not be as onerous as our current expectations are. I'm not going through the China story, but there is a meaningful slowdown which is taking place in China. I think this is extremely important, and we don't often talk about this, but how to invest and what are the important pillars of investing. I think one of the key things is to diversify. You need to diversify across asset classes. And what we've shown here is equity returns have been about 14%, volatility has been 18%. And interestingly, if you go from a 100% equity mix, you go to 80% equity, 10% debt, and 10% gold, your returns don't change much, but actually your risk comes down because these asset classes do well at different points of time. Normally when equities does badly, gold and fixed income does well, and vice versa, last year being an exception. So it's important to have a mix in your portfolio. Now, of course, the key question then is how much do I put in equity, how much in debt, how much in gold? Now that depends on your age, your risk appetite, your liquidity requirements, and so on. But the younger you are, the more you are in a wealth building phase, and that's when you want to take risk. Equity is high risk, high return. So when you're young, having 70, 80, 100% in equities makes sense. But as that profile changes and you get older, then you need to reduce that certainly and bring it down. And as you get into your 50s and 60s and 70s, you bring that equity component down from 70, 80% to 40, 50%. So I think diversifying across asset classes is incredibly important. Long-term investing is, I think, the most important part of equity investing. And let me just highlight some interesting numbers here. This is the VSE Sensex return since inception. And if you had invested for the entire period, you get a return of almost 15%, which is a fantastic return. Now, a lot of investors per se want to time the market, right? You want to get out in bad times, get in at good times, and do that as often as you can to enhance your returns. But the fact of the matter is, it is very, very hard to time the market. And it gets reflected in this chart because if you had missed, and this is starting from 1980 to now, so we're talking about 50 years. In that period of time, if you had missed the 40 best days, then and that's out of an extended period of time, your return profile of 15% falls to 4%. Right. So staying invested in the market is incredibly important. So I always tell investors, stick with the market even during tough times. I know the temptation is to take it out during tough times and get back in good times. But we don't know when the good times are coming and we don't know when the bad times are ending. So it's very difficult to time the market. Even if you invest at the wrong time, even if you sell at the worst time or you buy at the wrong time, if you hold for an extended period of time, your returns tend to still be very strong. So I think the key is investing for the long term. SIPs is a great way of doing this. And we've highlighted here that if you invest for a long period of time, it doesn't matter. The timing matters, but it doesn't matter. It's not that it doesn't matter at all, but the timing matters a little bit less. So here we've shown an investor who invested pre-January 2018 pre-correction and then post-correction a year later. And you can see return profiles since then have been quite similar. The same thing applies if you invested pre GFC and post GFC. That's the global financial crisis. Your returns actually turned out to be similar because you kept investing over a period of time when you caught market highs and market lows. So I think that's extremely important. And here at the end, we have a performance, which I'm not going to get through. But I think, very often, I'm going to remove the slide share. We talk a lot about equity markets and mid cap, small cap valuations. This is the right time, and so on. This is not about getting into the right fund, getting into the right market cap segment. The key to investing, number one, number two, number three, number four. Most important part is invest for the long term. The longer you invest, the more you'll capture that growth, and your return profile will be fantastic. Let me give you an example. If you invested in IT, even if you invested the worst time, and you invested in IT at the peak of the IT bubble in 2000, which is obviously the wrong time and the worst time to invest. But if you held on till today, so that's a 25-year period, your returns were still in the mid-teens. So despite investing in the wrong time, at the wrong time, you still had a fantastic return, or a reasonable return. So a lot of the mistakes that we make in equity markets, which is taking out at the wrong time and investing at the wrong time, if you invest long enough, then it really does wonders for your portfolio. So I think long-term investing is the most important. The second most important is asset allocation. So the key is to ask yourself, not how much of my portfolio is in winning funds and losing funds at that particular point of time, because that will change, but how much do I have in equities? Considering my risk profile, my liquidity requirements, so on, do I have enough in equities, or am I underinvested? So I think that's the second most. So the first is long-term investing. The second is having the right allocation to equities. And the third is to follow a balanced approach. You do SIPs, but SIPs is a big part of your investment strategy, but it's not the only part. You have to supplement that with lump sum. And when do you do lump sum? You do lump sum when things are falling apart. You do lump sum when the commentators on CNBC look extremely sad. You do lump sums when there is a lot of bad news. You do lump sums when everybody's doing when performance has been poor. So do SIPs on a regular basis. You can do lump sums on a occasional basis, and try and put money into the market when the market is doing badly. Be a little bit contrarian. So if you follow these approaches, if you follow a long-term approach, you follow a good asset allocation, enough in equities, and invest every once in a while a little bit more when markets are down, I'm extremely confident that markets will be a rewarding experience. So I think I've taken more than enough time. I will again thank all the participants for taking the time to speak with us, to join us today, and to hear us out.
Thanks, Chirag, for this comprehensive overview of the market economy. You covered Indian economy, you gave a global perspective, and more importantly, towards the end, you covered the key tenets of investing, which is so essential for investors' well-being and wealth creation. So इसी आशा के साथ हम आज का ये कॉल क्लोज करते हैं. Once again, Chirag, thank you very much for being on the call, and Ram, have a good year ahead. Thank you and Happy New Year to all of you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.